Hello, welcome. Thanks for joining us today. I'm Eric Mancini, Director of Investment Research and Partner at Traphagen. And today we're going to do a deep dive on the S&P 500 index. Everybody pretty much knows the index, but we're really going to look at how it's created, how it's maintained, and several other topics here where we're going to look at the sector composition of the S&P 500. We're going to look at the stock composition. Right now, it's the most concentrated in history. If you look at the top 1 stock, the top 5 stock, the top 10 stocks, how much of the total index did those make up? We're going to look at it 2023 so far, the returns of the S&P versus other stock market measures. And then finally, with this extreme concentration within the index in terms of sector and stock, how Traphagen looks to reduce inherent risks in terms of concentration risk and sector risk and stock risk given that. So we'll begin with, how is the S&P 500 created and maintained? Who does it? So it is a passive index in a sense, but in another sense, it is picked. It's an actively picked index chosen by 10 people. So there's a 10-person committee at S&P Dow Jones Indices, and that's a subsidiary of S&P Global, that selects the 500 companies that are within the index. So really, we think of it as an all-encompassing index of the U.S. stock market, but in reality, it is different than that, and we'll get into that later. And it is decided by 10-person committee. They each have an equal vote on what companies enter in. There are guidelines or rules. I'm not going to go through all of them, but you can see through here. And these mostly have to do with liquidity, size, profitability, how long the stock has been publicly traded, so it has to wait for a while after it IPO'd, and the amount of shares that are publicly held versus privately held or still within the company. And then given those guidelines, the committee's vote, the index is made up. And once a stock gets into the S&P 500, they want to maintain that as much as possible. So unless there's an overbearing reason to kick a stock out, which oftentimes there is, they will try to leave it as static as possible. But if a company is unprofitable for maybe 3, 4, 5 years straight, it's gone down in terms of size below a certain threshold, they will, again, the committee gets together, has a vote, kicks that company out, and then again, let's say there's 5 stocks out there that are eligible to be included now as the replacement into the S&P 500, that committee also votes on what stock is replaced. So sort of as a wrap up here, the S&P 500 is not really a true passive in the way we usually think of it, broad-based index. The S&P 500, I would say, is semi-active in the sense it's chosen, the stocks in there are chosen by 10 people in a committee. It's selective, so it's very high quality. These are very large cap companies, so these are the largest companies in the U.S. stock market that meets the criteria. 100% U.S. based, obviously, so you're not going to get any foreign. And as of now, it's very concentrated in technology. So as we'll look at in a second, about 40% of the index is technology. So, in a way, it's somewhat subjective what stocks go in, which ones leave. It's really screening for high quality. So a lot of the lower quality, the stocks that don't earn any profits, do not even get included in the S&P. It's only large cap. There's no small or mid cap in here, and it's largely technology. And that may be different than what many people think of the S&P 500. So right now we'll look at the sector composition. And currently, if you go by GICS sectors, which is the official sector company that keeps track of the sectors and run metrics on it within the S&P 500, or GICS, currently 26% of the S&P 500 is in tech, or information technology. However, partially because tech was just becoming an ever-increasing piece of the index, they took tech companies, what once were tech companies, such as Amazon, Tesla, Alphabet, Moderna, Netflix, Facebook, now Meta, companies that you would still probably think of as tech, and they rearranged the sectors, and they put Amazon into consumer discretionary, Tesla's in consumer discretionary, Meta and Alphabet are communications. So they sort of changed the sectors around. So officially, 26% of the S&P is in tech, but if you look at it a broad technology, how most people would view, I think most people probably would view Meta, Alphabet, Tesla, Amazon, Netflix as tech, then you get closer to 40% of the S&P is in tech or close to tech, and then 60% would be true non-technology sectors. And this is obviously a pretty heavy weight to technology in the S&P 500. Then if you go another level down, so that was sectors, if you look at it by individual stock, as of now, the top stock, so the biggest stock out there is Apple, which probably everybody knows, right around 3 trillion in market cap. And pretty amazingly, that's bigger than the entire small cap market. So every single company in the small cap index is, if you put them all together as one, is smaller than the biggest stock out there, which is pretty incredible. And that one top stock, which is Apple, makes up 7.6% of the entire index. So you have 500 companies in the S&P 500, or thereabouts. One company, the top, is worth 7.6% of that. If you take the top 5, it's about 24%, top 10's 31.5%, and if you take the top 25, it's 44.2%. This is the most concentrated we have ever seen in history, at least going back 40 to 50 years in terms of the S&P. And this is a chart here. It goes back to 1980, and this is looking only at the top holding, so the top #1 stock and the percentage it reached. So back in 1985, we had a very high concentration of 6.4%. That was an IBM. And that was on the back of, the revolution for broad computing, bringing mainframes and, just vastly more computing to all different companies in that technology. And that drove IBM to be in the top spot back in 84, 85 at 6.4%. Obviously, since then, IBM has fallen way, way down the list. And they have basically, they have done nothing for 10 to 15 years in terms of returns. Then in 1999, 2000, Microsoft took the #1 spot, and it was at about 5% holding. And that was near or close to the 2000 tech bubble. And that was on the back of desktop software, software in general, the Office suite, all things like that, where people were really starting to use these across the board in all types of environments along with the internet, and Microsoft reached a peak there at 5%. Then after the tech bubble burst, you had energy becoming more and more important for a period just before the Great Recession. So Exxon actually was the top holding at 5% back in 2007. And since then, Exxon has done very little since the middle 2000s. And right now, we have Apple at the top, far surpassing any one of these prior peaks and companies. And that's 7.4%, and that's obviously on the back of mobile technology. So it is the most concentrated we've seen, not just on the single stock level, but also when you look at a top 5, top 10, it is the most concentrated we've seen, and that does increase the risk. So here, this is looking at now the top 5 stocks. So going back to, again, the early 80s, if you just take the top 5 stocks, what percentage do those make up? We had a prior peak of maybe 18, 19% in the top 5 stocks in the year 2000 during the tech bubble. And then now we're back at all-time highs, really, just below 24%. So this is the most concentrated we've been. And again, if you're trying to invest in a well-diversified, broad basket of stocks that, are all different sectors, do all different things, maybe roughly the same weights, not very overweight in anything, the S&P might not be the vehicle to do it currently, given the makeup of it. And when we look at 2023 is a great example of where this can be a good thing for the markets, or if you flip it, it can be certainly a risk or a bad thing. So this is the returns of the S&P 500 so far. This is the beginning of June, so it's a little bit different now, but not too outdated. So at the beginning of June, the S&P was up 11%. The top 7 stocks, and that would be NVIDIA, Tesla, Google, Microsoft, Apple, Amazon, and Meta, those are up 53%. If you take all the other 493 companies in the US S&P 500, they have returned a net of 0 for the year. So it's basically been those 7 stocks that are so large and are up a 50% or more that's really dragging the entire S&P 500 up. Obviously, that's been a great thing for the index, which is good. Of course, though, the flip side of that, if something happens within tech or these specific companies and you get a reversal of that, it can have an outsized negative impact as well. And that's what we sort of saw in 22 last year. Given that, Traphagen still has a large amount in the S&P 500 index. So we still have, for most clients that have equity exposure, a very large percentage to the index. It's just very efficient. It's been proven over time that you want that exposure. But given the uniqueness of the time we're in now, where it's so concentrated in terms of sector and stocks, we have done other things to mitigate that risk, and that worked wonderfully in 2022. So some clients have already seen this screen. I'll just briefly go over this. So these are other strategies used via ETF that we use to get exposure to the stock market, the US stock market, without having to just go by the index and be doubly overweight or extremely exposed to a few different individual stocks. We do ourselves sector overweights, the ETF. So right now we're overweight healthcare, utilities, and not those big technology companies I just mentioned, but other smaller types of technology companies. So those we view as, for different reasons, we like those specific sectors. We're overweight there. And then through other managers, through ETFs, we do screens for high free cash flow yield versus the size of the company. So looking for the cheapest companies out there based on free cash flow available to shareholders. And that takes debt into account, so it penalizes a company for debt. We look at a strategy that really digs into the financial statements and adjusts the metrics, the price to earnings, the price to book, based on adjustments to the accounting statements. So goodwill is an example. Goodwill is a legal asset to have on your balance sheet, but it's a lower quality asset. So this strategy removes that from the balance sheet and then recalculates the metric and then weights those companies as such. And then this one has two screens running simultaneously. It's looking for high quality, so it's looking for low debt, high predictability of earnings, things like that. And then it pairs that with looking for high dividend yield. So the dividend yield on this strategy is about 3.7, 3.8%. The current dividend yield on the S&P 500 overall is maybe 1.5, 1.4%. So you're getting 2% more just purely in dividend yield with this strategy. So we complement, we still have that base of index exposure, but then we reduce risk, that concentration risk found in the index, with these other strategies that we could think either meet or possibly exceed the returns of the index over long periods of time, but definitely reduce risk. And that's what we see. So this chart is going back to the market bottom back in March of 2020 when COVID hit, basically the exact market bottom, and saying, okay, what did all these strategies that Traphagen now employs do from that point through June of this year, a couple days ago? So what we sort of basically have seen is from the market bottom back in March of 2020 through the period of very late 2021, early 22, is all these other TFG strategies, all these other Traphagen strategies we went through, with the exception of healthcare, outperformed the S&P 500. So that overweight to maybe energy, financials, materials, industrials, different things that are not well represented in the S&P 500, added value across all sectors except for healthcare over the S&P during that period. Then we went into 2022, which is this period in here, the darker green period, and this is where all strategies outperformed the S&P 500. So when we had tech really do poorly, it brought down the entire S&P 500 about 20%, where some of these strategies were unchanged. A couple of them were up a little bit, a couple of them were down a little bit, but every single one, including healthcare, far outperformed the S&P 500, and that was a great benefit to our clients, reduced risk substantially. Now this year, tech has done so well, and it outpaced all the other sectors. Basically every other sector is flat or down. Then it's been the reverse. So these strategies are temporarily underperforming, but that's going to be expected. If we hold things that are not correlated directly with the S&P, there's going to be time periods when we outperform, there's going to be time periods when we underperform, but we are of the belief, mainly for two reasons. One, we want to, with this historic concentration in the S&P 500 among sector and stock, we want to reduce that risk, that concentration risk. So we employed these other strategies. And two, we think if, over the long period of time, we could either meet or exceed the returns of the S&P 500 over a period of 3, 5, 10 years. and reduce risk as well. So we really like complementing our index exposure with these other strategies, especially now with the concentration risk within the S&P. And that's what I had for you. You know, it's an interesting time we're in. The S&P has never quite been this concentrated. So that's why we're looking at other strategies and employed them within the portfolios. And again, you'll see times of underperformance and outperformance, but over the long term, we're confident in the strategies. Thanks. Any questions, feel free to contact your Traphagen advisor or myself on the email below. Thanks. Have a great July 4th holiday. Bye-bye.